Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. What type of challenges will investors face in a slow growth economy? And how do you even invest in that type of an economic climate or an environment? Both questions our team will provide answers to. You know them, but I'll list them anyway. Editor-at-Large Steve Reitmeister, Senior Market Analyst Charles Rotblatt, and market technician Kevin Matris. Is that senior market analyst or senior market analyst? I don't know. Either one I think is okay.
Senior only on Cinco de Mayo.
Okay. So the street is looking for a real growth in the U.S. economy once we start pulling ourselves out in the third quarter of 2% versus 3% that everybody thought it might be. So the first question here is, do you all buy into the slow growth scenario?
Absolutely.
Okay.
Yes.
Charles?
Yes.
Okay. 2% real growth?
You know, I don't try and pretend to be an economist that knows the actual numbers, but if we say that 3% is like the normal growth rate for the U.S. economy, then I think, right, 1 to 2% is probably going to be the range as some people call it the muddle through kind of economy. And, you know, a lot of that has to do with this continuing of the deleveraging. And really, when the economy is going well and you can borrow money at cheap rates, that helps fuel additional growth. And so when people are reining back their use of debt, and here again, I'm talking about corporate America here, that one of the natural outcomes has to be slower growth that will come out of this. So, you know, we got a lot of baggage left over from this recession. So it's going to take a while to unwind. And I think we should be happy, that's the other thing, happy with 1 to 2% growth, because it's a lot better than the continuing to slide.
What do you think, Charles? Volatility, they say, is going to be the watchword. When things change, they're going to change rapidly as far as investors are concerned. What challenges are ahead?
Well, I think we've already seen the volatility. I think we're past seeing the volatility. It is interesting, as we record this on June 22nd, the World Bank came out and cut its global forecast. They're now calling for global output to drop by 2.9%. 2010, they're looking for a growth of 2% worldwide. But I think when you look at the U.S., it is going to be a slow growth scenario. We had this huge housing crisis. Now we have a large amount of inventory. Even though the housing market's showing signs of stabilization, we're still looking at the number of foreclosures rising. The home builders haven't seemed to grasp the concept completely that when you have excess supply, stop building. We just saw housing starts and permits rise. So I don't see that coming back. Obviously you look at the manufacturing base, which has been hit very hard, and we're certainly looking at a smaller U.S. automotive manufacturing base. So I think you have a lot of things that existed before we had this crash that won't necessarily rebound once we start getting a recovery. And I've said this before, I think we're going to have a recovery that's not going to feel like a recovery to many people, even though we see the numbers signaling that there is actually growth.
Slow growth, Kevin, at a time of sweeping changes to the financial system.
Right.
What do you think?
Well, I do think we are going to see slower growth, but I really don't think that that's, a huge cause for too much concern. The kind of crazy growth rates that we had seen over the last 5 years prior to the meltdown, as Steve had said, it was fueled by a lot of gross over-leveraging and almost indiscriminate availability of credit. So if we get into a period of, let's say, 2% growth, sustainable growth, a lot of people could argue that the kind of growth rates that we had seen weren't sustainable, and I think where we are right now in the economy is reflecting that. So there is a growing consensus, though, that we should be emerging from the recession within a couple of months to a handful of months. But yeah, I think that if we can see 2% growth, I think that is extremely welcomed, considering we were doing nothing but talking about contraction and the end of the world. So 2% growth is fine. But, we aren't going to see, in my opinion, financials lead the recovery. I think it's going to be, you're going to see subpar growth in that area on a long-term basis, subpar to what we had seen before. But look at all of the change, look at all of the innovation that is coming. You're going to see tons of opportunity in energy with clean energy. You're going to see a ton of opportunity in healthcare. You're going to see a ton of opportunity in so many different industries. So even though we are talking about only 2% growth on a national level and maybe even, reduced growth rates on a global basis, I think that you're going to see tremendous amounts of pockets of strength if you just know where to look.
So Charles, how does an investor then gear up for investing in this type of a climate that's going to bring a lot of challenges?
Well, I think there's a couple of things. First of all, we'll have to see what the next leadership group is. We're not seeing that right now. We really haven't seen it for several weeks now, so we're having this churning going on in the market. So we'll have to see. But I think when you're investing, I think, obviously if you're a trader, your focus has to be where earnings estimate revisions really going on, where are they the most current and going into those sectors. But if you're more of a long-term investor, I think you got to take a look at, okay, what's going to impact the world over the next few years? And there's some things we know. We know technology should do fairly well. And it's not just that we're seeing a start of the recovery in the semiconductor sector, but overall, if we do enter a phase of slow growth, it's really focus is going to be on what companies can actually enhance productivity. And I think technology can bring a lot to that. But I think you also got to keep an eye on commodities, world population growth, and even if we have worldwide growth, we'll see stronger growth in India, we'll see stronger growth in China. That's going to put demand on steel, it's going to put demand on oil, so I think there'll be opportunities there. But I think also for investors, it really comes down to what's always applied. Look for rising earnings estimates and reasonable valuations. And if you just stick to that basic rule, you're going to do fine regardless of what the economy or the market does.
Kevin, you're a technician. I have to think that technicals are going to play some kind of a part in investing in this kind of a climate.
Yeah, I mean, they will. But let me say one thing about the growth rate. The only thing that has me concerned, I don't think 2% is too big of a concern, but the only thing that does have me a bit concerned is we do need to reach a certain amount of growth in the United States to be able to absorb all of the new workers. So I'm not sure what that growth rate is, but I believe if we do grow at 2%, that should be enough to be able to bring unemployment down in a big way. But instead of trying to focus on which sector is going to be the best, although I think I tipped my hat when I was talking about healthcare and energy and technology, but what I think is this, check this out. You've got a tremendous amount of money on the side. And a lot of institutional money, a lot of portfolio managers, they have missed a good portion of this move. And I think that a lot of these guys, they have been reluctant to buy junk, and unfortunately junk has led the recent rally that we had seen. But they're going to have to put this money into the market eventually. And I do think that there is going to be a greater deal of demand for larger cap, more stable type companies because there does feel like there's a degree of safety there. And if these guys are stable with good balance sheets and are able to show decent growth rates, I think that that is going to be a very, very attractive place to be. I do think there's always going to be an attraction to small cap stocks, but large cap is going to be something that I think is going to be especially important and I think very attractive. But I do want to say too, even though we were saying that global growth is going to be slower, I do think you have to pay attention to the emerging markets because even if it's going to be slower than the past, you're still talking about growth rates 2 and 3 and 4 times that of the United States. You have to look at that place as well.
Steve, does a slow growth environment provide any greater risk to the investor?
No, actually, if we say slower growth, as long as it's growth and it's steady, it doesn't matter if it's 1%, 2%, or 3%. Really, that's an environment that has a clear trend. So the thing is, if we say that there's going to be 1 to 2% growth, will it be steady or not? Right. So if it's a steady environment, there's going to be plenty of opportunities for investors because there's going to be better visibility on who's going to have the best earnings outlooks. You'll be able to be in those companies. I agree that for a period of time, the large caps is a bit of safety. I would agree with that, but there's always going to be that look for excess return. And so there will be companies that make innovations in technology, in healthcare. I agree with some of those, or in retail. There's somebody who has a hot fad going on, and there's always going to be something that draws money out. Emerging markets, I agree. That if you got slow growth over here and you see these companies growing 20, 30, 40% a year, they're going to attract money. So the real issue is how steady is the growth, right. Okay? And that is a good question mark, and we don't know. But as long as there is some growth, there will be companies that will be doing well. They will have upwards estimate revisions. They will attract investor dollars. And I think we have one of the better models for how to spot those stocks as they emerge. So the industries and then the stocks within those industries.
All right, thanks to our panel members for weighing in on that. And remember, if you're accessing this video outside of Zacks.com, you want to get over to our homepage, Zacks.com. It's real simple to check out a lot of the other interesting and informative commentary that you'll find there. With everyone here at the Roundtable, I'm Terry Ruffalo.